When investors evaluate political leadership, they often look at one core question: how did the economy perform? Comparing the first presidential term of Donald Trump from 2017 to 2021 with his second term beginning in 2025 reveals two very different economic environments, shaped by global shocks, inflation cycles, and structural policy changes. During Trump's first term, the U.S. economy experienced steady GDP expansion before the pandemic. In 2018, real GDP growth reached approximately 2.9%, supported by corporate tax cuts under the Tax Cuts and Jobs Act. The unemployment rate fell to 3.5% in 2019, the lowest in nearly 50 years. Stock markets surged during this period, with the S&P 500 rising over 60% between early 2017 and early 2020. Business confidence was strong. Deregulation, increased corporate investment, and consumer spending remained resilient. However, 2020 dramatically changed the trajectory. The COVID-19 shock triggered a sharp contraction of around negative 3.4% GDP for the year. Unemployment spiked briefly to nearly 15% during the lockdown period before recovering. Massive fiscal stimulus packages were introduced to stabilize financial markets and households. By the end of the first term, the economy was rebounding, but faced elevated deficits and supply chain stress. Now compare that to Trump's second term, beginning in 2025. Unlike 2017, this term starts in a post-pandemic higher interest rate environment. Inflation pressures that surged globally between 2021 and 2023 reshaped monetary policy expectations. The Federal Reserve entered 2025 with rates significantly higher than during Trump's first-term start. That means economic growth dynamics are different. Borrowing costs, housing activity, and corporate investment respond differently under tighter financial conditions. Early second-term economic indicators show moderate growth, but with slower momentum compared to the pre-pandemic expansion years. Labor markets remain relatively tight, but wage growth has moderated. Trade policy discussions have re-emerged, and markets are closely watching whether tariffs, tax adjustments, or fiscal expansion measures will reshape inflation trends again. The biggest difference between the two terms is the starting point. The first term began during a stable global expansion, with low inflation and accommodative monetary policy. The second term begins in a more fragile global environment, marked by geopolitical tensions, higher public debt, and cautious investor sentiment. For markets, what matters most is not just past performance, but policy direction. Will fiscal stimulus expand deficits further? Will trade tensions rise? Will deregulation accelerate growth or increase volatility? The economic comparison between Trump's two terms highlights how leadership interacts with global cycles. The first term rode a pre-pandemic expansion wave before a historic shock. The second term must navigate a structurally different, more complex macroeconomic landscape. The real question investors are asking now: can growth accelerate again under tighter financial conditions, or will global pressures limit economic upside in 2026? Follow Global Economic Lens for data-driven macro analysis.